Welcome to Real Estate Accredited, where we go over the nuts and bolts of real estate investing. Normally, we go over commercial real estate, but today we're shifting gears a little bit and talking about private lending. So I'm your host today, Jeff Rodriguez. I am a co-founder of Boost Capital Group, a firm that focuses on helping busy professionals invest in real estate assets passively. We've been at it for over a decade now. Philip Schuligan and Chris Price are partners in the firm. They are currently attending Dealmaker Live there in Atlanta. They're representing the company down that area today. Let me get into today's discussion, which is unveiling private lending for private investors. Have any of you folks been lenders or borrowers in rehab properties?
Yeah,
Yes, I'm a private lender.
Okay, good.
I'm a
So
private lender.
so you could sharpshoot everything I say here and tell me how wrong I am. Like I said, normally our audience is focusing, trying to grow into commercial real estate, and you're probably participating in commercial as well, Jay.
Yep.
But this is for the masses, and it's like a coverall, and definitely value your opinions on this. So let me get into it. Oh, a disclosure real quick. We do not provide tax or legal advice. The information here is for informational purposes only, and it's not construed as investment advice or an offer for solicitation to buy or sell securities. All right, now we got the disclosure out of the way. So private lending for private investors. There's a lot of investors that we talk to who are not enamored with the long-term investment plan on commercial real estate opportunities, 3 to 5 years. Sometimes they're interested in the shorter term aspects. So we like to give them this as an option. So usually we have to educate them as well. So this is a attempt to educate folks that are not familiar with that. So private lending, hard money lending, right? What is it? Short-term, this surface level information. Short-term loans secured by real estate, because we're talking about real estate acquisitions and deals here. So unlike the traditional bank loans, they are funded by private investors or with emphasis on the actual property, not so much the credit value of the individual, because someone's credit can't pay the bills. The deal, the value in the property, what can pay the bills if, say, the deal goes sour, right? So that's pretty much the introduction to private lending. Key players, which one could you be? You could be all three, you could be just one, but normally the borrower is a rehabber or some fashion that's looking for finance a project, whether it's a fix and flip or a just buy a property from the courthouse. They need capital real quick in order to maybe finance the deal later through a bank loan or some fashion. So usually the borrower is looking for quick capital for their deal. But normally, in our experience, are borrowers that are looking to rehab properties and then pay our money back. As a lender, obviously, it could be a company, but you need to have a lot of processes in place. Like Jay probably could chime some information on this. You need to have your processes in place, documentation. You need to know how to assess the deal, do your due diligence, and that those borrowers, the investor or the rehabber, has the property contract company, property insurance. There's a lot of things that go into it. So just being a lender is just not having money to lend. There's a lot of situations where you need to make sure everything is in order to get that money back legally as well. So you could be a lender that offers money to these borrowers. And then you could be an investor, which is somebody that pretty much works with a lender or a company that has this type of a fund, who lends money out. So you could be an investor, just has capital in a bank or your 401k from an old account that you want to put to work. You could lend that money into that deal, and then you get your returns, whether there's pref equity in the deal of some fashion. But as an individual investor, you just providing the capital and and 12% on the capital you lend, or even 8%, depending on what the deal looks like. How's that sound, Jay?
Yep, sounds right.
All right, sounds good. All right, so characteristics of hard money. Why do people go with hard money, or investors go with hard money? Or why do they need it? 6-month turnaround, 3 years. So usually short term is the biggest catalyst of borrowing hard money. They don't need it for a 30-year fix or a 15-year. Usually it's a quick turnaround. So that's why short-term hard money lending or borrowing is very attractive to borrowers. Now, the interest rates usually reflect higher than traditional lending because it costs money to borrow. It costs money for you to get that money quicker, right? So there's a higher interest rates involved when you're borrowing money as compared to traditional bank loans, which are usually require a whole lot of work, a whole lot of paperwork. So that's why as investors borrowing, you pay a little bit more for that capital. And then it's based on the property that you are securing that deal with. So making sure that deal is a good collateral for the capital that's being lent. And it's, like I said, it's quicker approval process than traditional bank loans. So you need to close on it quick. You come across this deal and the wholesaler says, hey, I got 10 days to sell this deal. Whoever comes with the capital quickest gets the prize. That's the motivational factor for quick approval, because that capital is already available and it doesn't go through the red tape, for lack of a better term, of traditional bank borrowing. So the loan process. Now, depending on where the individual as a private lender is, they can have their own loan process. You could have your own application that every borrower. So the application and approval process requires obviously an application of some fashion. However, the funding personnel requires that application you provide. The lender obviously assesses the property, makes sure that you're lending on a property that's $200,000. You got to make sure that property's value is $200,000 or above, because if you're lending, chances are you're not in the business of looking to rehab properties. You just want to make money on the money you lend, right? So you got to make sure there's value there. So if things go sour, you can sell that property at that low price and not have to increase that property cost just to recoup what you borrowed. So the property value is very important. Then that comes with underwriting the due diligence. You do a thorough due diligence as the lender and ensure that the property will appraise. So you're looking at an ARV based the after repair value of that property that will sell later on down the road to make sure you get your capital back. And then perform background checks. You can use like companies like Been Verified to do a background check on the individuals that would be borrowing money. Who do you use, Jay? Do you use?
I'm a broker, so we have different companies that use different other companies to assess the credit worthiness and the background and stuff like that. I'm just a gatherer of information. I'm making connections with the borrowers and the lenders.
Same for me.
Jeff, I don't like the way you're staring at us. I think we blew his mind.
As brokers, we have an open opportunity to find the right lender for the client or the individual that we're doing business with. That's
Yep.
another way we can play it.
Yep.
I'm back. I do apologize.
Oh, welcome, Jeff.
I'm just having all the luck today, aren't
We were winging it while you were gone.
I?
So it all worked.
I appreciate you. Let me get back into that. All right. Are we back?
Yes, we are.
All right. Thank you, Jay. All right. Yeah. So pretty much the loan process is very simple once you do it multiple times. There's just a lot of due diligence and a lot of checklist kind of process in order to make sure that you're able to get your money back and that the asset that is being lent on meets those value and the expectations of what you as the lender require. Everything's approved. then you wire funds, right? Usually the recommendation is wire funds to the financial institution or the title company. We don't like wiring directly to the borrower for obvious reasons. Usually if the deals, you would usually have a title company that they're going to be working with. Normally we would just wire the money to the title company to make sure everything timely and properly executed. Yeah. All right, next slide. This is a continuance of characteristics. The collateral. So back to the lender focuses on the value and equity of the property. You got to make sure that there's enough equity in the property or value in the property in order to lend on it. And because it's served as collateral, right? So you're securing that money, just like all real estate transactions, I would say, whether it's commercial, whether it's apartment complexes or smaller storage, everything has to be secured with that specific asset. You're not going to invest if the asset is not secure. You're not going to invest in it. You got to make sure that that property is not going to go anywhere. It's not like stocks. It's not going to disappear. So always, collateral. Terms and conditions. Interest rates on these private loans typically range from, what do you say, Jay?
Yeah, we're 8 to 14%.
8 to 14%?
Yeah.
Okay. Yeah, I mean, you look at what the market's doing right now with the higher interest rates. So I guess, it's just a roller coaster ride with that. So you stick to what the current interest rates are from the Fed. So is that how you guys also move based on what is the funds rate?
Well, yeah, as the rates go up by the Fed, our rates will go up as well.
Okay. Yeah, usually, and that sounds about normal. That's been like that. Even when they were 3%, you could expect to lend money and expect at least a 10, even when Fed rates were like 3%. So 3% for regular traditional loans. We've lent money out when it was rates at 3 to 12%, for quick turnaround, 6-9 months loans at annual, which leads me to loan duration. Short-term loans, normally 6%, 6 months, 6 to 9 months for residential, depending on the amount of work, or 3 years if it's like a larger construction project. So you can see that variation, but normally for residential, you can see less than a year. And then points and fees, we charge normally about on the time of purchase, and then another point when it sells at the end of the term of the loan. How do you guys operate, Jay?
I usually charge mine upfront. I will charge, the bigger the project, the lower the points I'll charge. So I'll charge half a point to 2 points.
Okay. Yeah, so we're funding smaller residential, so that makes sense because they're usually 2, 3, $400,000 properties. Now, when you get to the millions, that point does make a difference.
Yeah.
So chopping those points by several basis points does help, but you still walk away with pretty hefty points in your pocket as the lender.
Mm-hmm.
Some hesitation in the sound.
Again, Denise?
Hesitation in the sound. I don't know if you can detect it outside.
Yeah, I could hear Jay just fine. Jay, can you hear me?
Yeah, I can hear you just fine. Denise, you have a reverberation behind you.
Yeah, I can hear you guys. Yes.
Yeah.
Okay, just check.
Okay. All right. Sorry about that. All right. So going on to roles of the borrower in private lending. So pretty much the target demographic, who's going to borrow this capital: real estate investors, rehabbers, developers, and sometimes wholesalers. So we've worked with some wholesalers who acquire some properties from courthouses with private money, and then they find their end buyers. Sometimes they don't have their end buyers, but they'll acquire property because it really, and they sometimes would either keep the property and refinance it if the refinance makes sense. So I didn't put wholesalers because that's not very common. I don't know about you, Jay, but we don't see that very common, but it has happened. And that's also a target demographic as a private lender as
Yeah.
well.
Same with me.
Okay. Solid. All right. The borrowers, are you looking for short-term financing, as we stated, in order to secure that asset that they're looking to acquire? Because a traditional bank usually requires a longer length of time and a lot of paperwork. Usually they're pretty slow with their process. Now, common use cases, obviously, flip projects, short-term financing, bridge loans, and it goes back to the bridge loan. The bridge loan can be a quick purchase from an individual or foreclosure or something. It just helps that individual close that deal and then go get the financing that they may need a longer time. Or sometimes, say, a individual has the money to buy the property, but they need capital to rehab, then you could provide a bridge loan in order to make them whole. So there's different ways, creative ways to lend money. What are some ways that you've, Jay, for like bridge loans other than, commercial?
I haven't done any bridge loans.
Okay. All right. Those are you can charge higher rates because you're not the original individual loaning on that property where it's secured with that original promissory note. So you're like a second place on that deal. So then you can actually charge a higher interest rate because of that deviation of not being the first place on that loan. So you can charge higher interest rates or more points, but if they can't get that capital to rehab that property, then it's stuck. So that's why you could charge a little bit more to cover that gap. And it's like a niche too. I mean, you can be just a guy that or the gal that provides capital for rehabs. You could probably charge a little bit of a higher interest rate. So just something to consider. And then risk and rewards from the lender or investor's perspective. Obviously, due diligence is always encouraged and required. Make sure that what you're lending is properly collateralized with the value of the asset. And then obviously, this allows you your reward diversification of investments. And what I mean that is, in regards to that, is diversification of your total portfolio of investments. So you got your stocks, bonds, things of that nature. This allows you to step away from the stocks and bonds world and diversify your portfolio into different type of investments. They're invested in tangible assets like real estate. And then obviously the higher interest rates are definitely a lot more attractive, and the potential for fees that you can charge for originating a loan for these type of or deals. And investment criteria. So the type of properties you'll see, and again, we're just talking about real estate, residential, commercial, or mixed use properties, focusing on the strong demand. So population growth, job growth are always great. And then income growth, you always want to look at those places. Those are going to be the attractive places where people are moving, meaning you're doing, like I said, residential, then chances are that property is going to be off the market a lot quicker than a really boring area that doesn't have that much of a strong market. Now, experience level of the borrower, you have to evaluate their track record, make sure you get what they've done in the past, confirm what they've done in the past in order to know that they're going to be able to complete the project. You look at the business plan and just full-blown due diligence on that deal. Sound about right? Okay.
Yep.
All right. So, how investors make money. All right. So as we discussed, higher interest rates are the attractive aspect of being a lender. Quicker access to capital is the attractive aspect for the borrower. So as a person that's a private lender, lending private money, your own money, you get higher yields than traditional deals. You can also collect capital from just interest loans. So you're collecting interest loans or interest payments the entire time as the individual rehabbing whatever property is paying you. And then you collect the remainder of that capital back at the end of the deal, plus the points that you've agreed upon. Now, prepaying a penalty, we technically don't Usually we don't do prepayment penalties because I'm not gonna penalize somebody for giving my money back quicker. Larger deals I get because they lose some of that interest, but normally we're happy if the deal goes through, everybody's, makes some money and we're able to recoup that money and we could rinse and repeat and lend out on that deal a lot quicker than just forcing a borrower to hold on to that capital until that time frame. Because if they get done quicker, we welcome that capital back. Or is that your standard practice, the prepayment penalty? I'm sure for larger deals it is.
Once again, we go through different companies that provide the funds. As far as I know, none of them have charged a prepayment penalty. Pretty much, we don't charge prepayment penalties.
Okay. All right. Yeah, we have not either. We encourage you to pay our money back. So,
Yeah.
and then they could get to work on the next deal and just repeat customers. That's the benefit of it. Don't try to nickel and dime, even though prepayment penalties is a good area to collect some additional capital.
Yeah.
It's to each his own. And here you go. We're talking about fees and points, origination fees and points. Like I said, we will charge a point up front and a point on the back end, and just collect our interest only payments throughout the loan. And then asset appreciation, making sure the property is increasing in value. Usually 6 months is not going to be a huge shift, but when you're talking about the 3-year loan on some properties and making sure that there's going to be appreciation in the area, that's part of your due diligence process, looking at the business plan and just ensuring that that area, that property is positioned for growth based on what everything else around that asset. And then we don't really participate equity participation. We usually just straightforward promissory note of some fashion, but you have the opportunity to still to benefit from the upside of a property if you're offered an equity position on the property for a resale or a refinance. For our commercial real estate, the apartment complex deals that we bring investors on, they always get an equity position of some fashion. They benefit from the upside. Like I said, it's based on the creative financing and the deal structure as well. Now, strategies for success in private lending. So this allows you to pretty much spread your investment across different properties to mitigate your risk. And I'm referring to stocks and bonds versus also investing in real estate assets. And then you have to have a good underwriting process. If you're going to be a lender, you got to make sure that you know what you're doing. You got to know the market, and you have to make sure that all due diligence and risk assessments are taken into account in order to safeguard your investment. And then understand the economic conditions of the market you are investing in. That is very important for all our multifamily deals. We dive real deep in the economic conditions of that market, both the macro and the microeconomics of those deals. Very important. And that is the end of my presentation. Again, Philippe and Chris are my partners on this program. They are currently in Atlanta, but if you want to reach out to any of us, suggest topics of discussion, or you just want to talk offline about deals or working together, there's our link. You can schedule a call. Check out our website. We have the YouTube channel where we post all these videos, and we always welcome you back. If you have any questions, shoot.
No, it was a very good presentation.
Thank you. I appreciate you guys taking the time on this Thursday night. And again, we're here every Thursday. Next week is going to be on back on the commercial real estate side of things, multifamily focused. And again, we welcome any suggestions that you may want us to go over, and we could prepare something. No big deal. We want our audience. But like I said, we record these, we post them on our YouTube channel, and welcome anybody to stop by and say hello. All right, I'm gonna stop sharing. Again, if you guys want to reach out to me, you can reach me at jeff@boostmycapital.com or my partners, and you can check us out at boostmycapital.com. We have different items on there. We have blogs, presentations, things of that nature. But again, I will thank you for stopping by, and I look forward to seeing you guys next time.
Excellent.
thank you.
Thank you, Jeff.
Thank
Yeah,
you.
thank you. Thanks for the presentation.
Absolutely. All right, just have a good evening.
You too.
Thank you. Bye.